What's up, YouTube? Welcome back to another video. Welcome back to another informational video. All right, so we're going to be talking about liquidity today. Liquidity and, in relation to market structure and, just talking about how liquidity and market structure relate to each other. Okay, if you guys don't know what liquidity is, we're going to cover liquidity a little bit. We're going to do that for the first half, and then we'll cover some of the market structure and everything like that and just putting everything together. I feel like the trading community as a whole was misled on what smart money concepts are. Well, when you think about it, you listen to the name SMC, it says smart money concepts, right? That last word, concepts. And I think everyone was trying to use smart money concepts as just a strategy, and it's not a strategy, it's concepts, right? Smart money concepts. Liquidity is part of those concepts, right? Imbalances, right? Fair value gaps, order blocks, okay, impulsive moves, time and price, all of these different things are all part of those concepts, right? When you say smart money concepts, it's not just, oh, it's this strategy. No, it is a umbrella of different concepts inside of it. Now, you don't have to use every concept, and I don't use every concept. I use majority of them, and then you can add on to that as well. So this is just something that I really came to my mind that I want to talk about. But let's get straight into it. Talk about liquidity. I mean, you guys can see here I'm on GU, and I'm showing you some liquidity already. All right, and one thing you'll notice about liquidity is underneath every low, every high, like everyone tells you. That is true, but you need to understand what is the most important areas of liquidity. What liquidity is most important than the others? So for example, liquidity is being built at highs and lows. Okay, you can say every high and low has liquidity. All right, but that doesn't mean that the market is going to go for every high and low. So what do I mean? All right, if we are in a bearish structure, and this is why structure is important. If we are in a bearish structure, and let's say you see something like this, and you see these highs right here, and that is potential liquidity. Let's say, boom. Let's say they're not equal highs, but they're relative equal highs, and you see this going to the downside like this. And a lot of people would think, okay, the market is going lower, but we have liquidity up here. The market's going to have to come and take that liquidity. No, it does not have to. Why? Because we are already bearish. So the market is going to be more inclined to target, let's say we have this right here. The market is going to be more inclined to target this liquidity then it is going to be more inclined to target that liquidity. Okay, so that is something I want you to focus on. Structure is very important. Okay, that is going to tell you which areas you should be targeting and which liquidity pools you should be targeting. So for example here on GU, we can see we have trendline liquidity here. There's different forms of liquidity, okay? We have trendline liquidity, we have double tops, double bottoms, right? Liquidity is everywhere in the market, but you have to understand what areas is true liquidity and what areas is just a high or a low, okay? A good example here is you can see that we have built up money here on these lows, right? This is a trend line. You can see we have accumulations and mitigations. All right, accumulations and mitigations. The market is building a lot of buying pressure here. There is a lot of liquidity sitting underneath here because you can see that we're not rating these lows. You can see we're just going higher, right? Going higher, mitigating, going higher, mitigating, going higher. We're not rating any of these lows. We're maintaining these lows, which means there's a lot of buying pressure here. There must have been people buying the market here, seeing that we're getting this little trend to the upside. This is how we know that there's liquidity here. And most likely than not, the market will come and target this liquidity. Doesn't mean it has to come immediately. And this is why structure is important, because the market has objectives that it has to meet, okay? So us building this liquidity here is key for us to see, but you can see the market is still going higher, right? We didn't immediately come for this liquidity that's sitting here. Now, what we're talking about here is structure. We can see we have a bearish structure from the high to the low. The market is going lower. So as the market is printing this liquidity here, we're not expecting the market to just immediately come for that. It would be a waste. Why? Because why wouldn't they continue the market higher, fill some imbalances, right? This is where the imbalances and the smart money concepts come into play, because we have imbalances to fill. As we know, the market comes and it wants to fill imbalances because we want a fair pricing in the market, right? So most of the time the market will come and fill imbalances. Now, It doesn't mean it always has to. You can see the market came here and we filled some of the imbalance, right? As we came here, we filled some of the imbalance and then we went lower. And then you can see we came back and we filled the rest of the imbalance, majority of it again, right? And then we have our supply zone, which is the origin of the move to the downside. So let's get back on track, right? We have this liquidity sitting here. You can see the market continued higher, leaving that liquidity pool there, making it even stronger because buyers are now way more enticed that, okay, this is a good area here. This trend line is holding, right? You have retail traders that still trace patterns and everything. And doesn't mean the patterns don't work. They do work, right? It's just that it is a form of liquidity as well. Okay, so we have the trend line liquidity sitting here. And as you can see, the market goes higher. Now, as soon as we break this low here, and this is what I'm waiting for, I know we're coming for this liquidity. Why do I know that? Because that is the first invalidation of potential buyers. So we have low, high, low, high, low, high, low, high, right? As the market is going higher. Okay, as soon as we invalidate one of these lows here, as soon as we invalidate this low, so since this was the most recent low right there, once the market invalidates this low, I'm expecting some type of retracement, and then this is going to be my target for us to take out this liquidity. This is how you use liquidity. You want to use liquidity as targets, okay? You want to know when the market is ready to induce liquidity and when you should be waiting for the liquidity to get rated. So for example, we have this area here. Okay, look at these double highs. Oh, look at this double top right here. We have this high and this high right here. And you can see the impulse that the market made to raid these highs before we went lower. Okay, another example right here. Look at all of these lows, 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 lows. And you can see the market impulse underneath these lows. And then we went higher. Okay, now this, granted, this was during, you know, December. I don't trade during that time, so I wasn't even trading any of this, but that is something I want you guys to look at, and just understanding the nature of liquidity and how to spot liquidity. Okay, it's easy to spot liquidity. You have to ask yourself, where are the buyers or where are the sellers? In this case, let's zoom in. We also have something called Asian session liquidity. All right, Asian session, one thing that I teach a lot is this Asian session liquidity. Asian session is the easiest form of liquidity to understand, right? Why? Because Asian session is usually consolidating. When we are consolidating, the market is building a lot of bias for buyers and bias for sellers. Okay, so this is one of the major forms of liquidity that we use on a day-to-day basis is Asian session, because Asian session, like I said, is usually consolidating. So let's say the market is, you know, coming out in Asian session form. Asian session will usually look something like this, or sometimes we'll move more, but most of the time we're usually ranging. Above these highs is liquidity, and then on the lows is liquidity. Now, how do you know which one should get rated? How do you know which direction that you want the market to go? This is where structure comes to play. If you are in a bullish structure, the market is going higher and you want to see buyers, then what do you want to see? You want to see the lows taken out. So you want to see the market do something like this. Boom. Sometimes we will take out the high too, but your most important is gonna be the lows, because you want to see the market goes higher. So you want the market to induce sellers, right? This is how liquidity is taken. The market will induce sellers. So we will induce to the downside, sweeping the lows, and then we will go higher, make a BOS, and that is your liquidity sweep. Okay, this is your liquidity sweep of Asian, and then you take your entries to go. So here's another example right here. And we're going to go into the market. We're going to look at some of these Asian sessions right here. Now, granted, like, look at this. This is all a range right here. You see, this is a range right here. So I'm not trading within this. Okay. And you can see the market is sweeping Asian lows here. This is the gray. We're sweeping Asian lows and we're sweeping Asian highs right here. Now, this is not a good example since I'm not trading this. This is a range, right? We don't want to be trading in ranges. We want to stay out of ranges, right? My strategy and the way I trade, I stay out of ranges. I'm looking for the market to give me a trending market. And this is why we're waiting for this low. But here's a good example right here. Here's a better example. So you can see in this case, well, I mean, we're still in the range, but this is a better example. You can see in this case, as soon as London session opens, we take out the lows. Boom. We take out the lows. right? The market goes higher, we mitigate, and then we continue higher. All right, now look what New York session does. New York session goes higher and manipulates the London session highs. Okay, we manipulate the London session, and look what we do. We continue lower. What does that tell me? Now, this becomes a valid area for me. As soon as once we go lower and we can break this low right here and we can show that impulse, once we do that, now I know this is a valid area to look for sales. Why? Because we swept liquidity here, meaning that we had potential sellers within this area. This is how I use liquidity, okay? This is how I use liquidity to determine what areas I should buy or sell from. So there's two ways you can use liquidity. You can use liquidity to determine your manipulations, right? Looking at your manipulations and seeing if those areas actually rated liquidity. So this becomes a valid manipulation because I know that we rated liquidity. Liquidity of what? Liquidity of London session. What makes that important is because we can see that London session actually created some type of movement. It looks like we stayed within a range mostly than not, but we can see it created this type of movement. That impulse of New York that comes up here purposely to take out these highs, and you can see we move aggressively to the downside, right? Look at all these imbalances that we're leaving here. That shows aggression from sellers. That means that we had to induce towards the upside to take out these highs, and then sellers said, let's go, right? Aggressively pushing to the downside. Now, when the market comes back, this becomes a valid area for me to sell from because I know that this right here was a manipulation of these highs to sweep liquidity for the market to move, right? The market needs liquidity to move. In order to be a buyer, you must have sellers, right? Understand that if you're buying, someone is losing. Just understand that right there. The market cannot move without liquidity. So you're probably thinking to yourself, aren't these highs liquidity right here? Of course they are. And this is why we're waiting for the change of character, right? This is where the structure comes in to know which areas is going to get invalidated or which areas of the liquidity is going to get swept and which areas we should not worry about. If the market goes ahead and breaks this low right here and creates this change of character, I am not going to be worried about this liquidity anymore. The reason why I am not in this market or selling this market yet, and the reason why I'm not participating in sales is because of this liquidity that is sitting up here. Now, as soon as we break this low, creating that change of character / BOS, right, that's going to show us our break of market structure, I am not going to worry about this liquidity pool anymore because structure is more important. All right, structure is more important, right? Structure is number one. You have to follow the structure first. All right, if the market is showing me that we're shifting back to the downside, as you can see here, we were going higher, but as soon as we break this low, that shows a shift in market structure. If the market is showing me that it's shifting back to the downside, that means we probably do not need any more liquidity. And I know it's higher probability that once we do create this change of character, I can sell to the downside because that shows a shift in market structure. We have a change of character, and now we're aligning back to the higher time frame move to the downside already because we were already bearish, right? All of this is a pullback. So you see how we're adding all of that in together. This is the relationship between structure and liquidity. This is what I wanted to show you guys in this video. So I hope you guys understood this simplified video of liquidity in relation to structure and how to know what areas is going to get swept and what areas is not going to get swept. All right. And all of these is probabilities. I want you to understand the market is all probabilities. So I know it is a higher probability for me to take a sell from here once we break this low. Now, if I was to try to take sales before we broke this low here, it would be a low probability sell up because I do have liquidity sitting up here. Okay, that is the difference between that, and you have to back test that. It's something I've back tested, so I don't worry about a liquidity if I am a part of the market structure. If I know that I'm on the right side of the market structure, I use liquidity to my advantage. Okay, that's when I'll be able to, let's say, predict what areas is going to get swept. So like I said before, last example, if we're in a bullish market and I see the market ranging, I am going to already presume that we are going to sweep these lows. I actually want to see these lows swept, and then the market goes higher because I know that we are in a bullish market. So I should be looking for the market to sweep the lows and to create that manipulation so I can get my trades to the upside. At that point, now I don't have to worry about the liquidity anymore because it's already swept. right? So that is a basic example of, you know, how to use liquidity and how to spot liquidity in that notion. All right, now all of this is just basic, right? All of this is just basic stuff. Now we do teach this more in depth. Well, I teach this more in depth, and there's more to it than that. And you know, we have Wyckoff and everything else that we add within our concepts. It's not just liquidity, right? Liquidity is just a part of it. We have Wyckoff, we have, you know, our market structure, supply and demand, all these extra things that we add on to it, so we know, you know, what areas and stuff like that we should be taking. But I just wanted to show you guys the liquidity and how we use that from our day-to-day trading. All right, so I hope you guys enjoyed this video. Peace out.